no PAT, net operating profit after taxes in times 0 times my 1 minus growth over return on invested capital. And we'll jump into what that means here in a second. Divided by my required return minus growth. Very simple, cut and dry calculation. So if we go, we'll kind of start breaking this down. So growth over return on invested capital is my reinvestment rate. Growth isn't free. Sometimes, well, there are special business models that can actually grow without reinvesting capital, but that's not typical. Most companies need to reinvest at least some type of capital into their business to sustain growth. Even at a sustainable growth rate, which we'll get to, which will be very conservative, they have to reinvest something. Does anybody know what formula that looks like? If we use some algebra to flip things around.
In the growth model? No?
Well, yeah, close. Yeah, the concept comes from there, but the sustainable growth. So that's my G equals my return on invested capital. I'm going to start going behind this screen on the exit. So times my reinvestment rate. So if I assume I can continue to earn, we'll say, a good healthy return on invested capital of 20%, if my next dollar that I invest in the business will return 20%, I reinvest a dollar, my growth rate would be, or 20%. So if I make, sorry, I'm not a professor, so I gotta slow my mind down and actually give you guys examples. So say we make $10 in year 1. FY1. And we have a return on invested capital of 20%. How much money are we going to make that year? We have $10 invested, our return on invested capital is 20%. You can speak up, man. Two. Okay, I make $2. What if I reinvest 100%? So I'll do my reinvestment rate at 100%. So I'm going to reinvest that $2 next year, assuming my existing capital still makes me 20%. If I reinvest that at 20%, how much am I going to make off of that? How much am I going to make off of my $12? Somebody's got to help me out with calculations here. I now have $12 invested. Isn't that like when I have 2.4, something like that? Okay. 2.4 divided by 2 minus 1. What's that equal? 20%. There you go. You're keeping up with me. 20%. So that's just mathematically how it's going to populate. But this is a pretty standard calculation. If you go the CFA route, that's pretty standard calculation through level 1 and level 2. So that's where we derive our reinvestment rate from. Because all the money we make, if we assume any growth above 0, we have to reinvest something. So we can't distribute all these earnings to our capital holders. I'm going to use up too much of my board too. I had a whole plan, so I had space. But there you go. So reinvestment rate. Let's go RR for that. All right. Next, net operating profit. So net operating profit is any cash that can then be distributed to anybody who has claimed on capital. So we have equity holders and debt holders. So if I start with net income, there's a couple ways to calculate it, but the easiest ones would be operating income, or EBIT, times 1 minus my tax rate, which in the US is typically a 21% tax rate. That does fluctuate between companies, but for simplicity reasons, we use 21%. Or we can do net income plus interest, subtract out the tax benefit of interest. So typically that's just tax benefit equals interest, or interest times your tax rate. Why do we have to subtract out the benefit of interest? Does anybody know? From accounting? It's because debt's tax advantage capital, so we have some type of tax shield by having interest because we subtract that out before taxes. Is that right, Will?
Oh yeah, 331 right there.
All right. Well, I gotta ask the accounting guy in the room. I don't want to say anything wrong here. So, this is our notepad that we'll use. In our example, we'll add in another layer, but we'll get to that. So does that kind of make sense to everybody? We want to add back in actual earnings to these debt holders, well, capital holders, so equity and debt. So that's why we add back interest when we calculate that. All right. So we have notepad. We have our reinvestment rate, so we understand that. What this will give us is cash after I reinvest into the business, what's distributable to our capital holders. Next, let's just talk about growth real quick. This is what we'd call a single stage model. If I assume, let's assume 8% growth. Do we think that's logical? This is a perpetual model into from now to forever. Can anything grow faster than the normal economy? Forever. The answer to that is no. It'll make your model look really, really nice, but you can't do that. So what I do in this general sense is I just have a sustainable growth rate equal to GDP. And in most cases, that also might be a little bit aggressive. But when we're looking at what we think are high quality companies with a lot of staying power, we usually just use growth equals long-term GDP equals roughly 2%. If I want to be aggressive in this type of valuation, I'll use 2%. If I don't, I'll use 0. If I use 0, we got any math wizards in here? What's that equal? 1. We don't have to do anything. We're not reinvesting any money to grow, so we don't have to do anything. All right, so any questions on why we use 2 as a growth rate or roughly equal to GDP? Either that or 0. That's basically the bands we operate in. We don't try to get too fancy with any of that, especially in these single stage models. All right, what else do we got up here? Next, return on invested capital. Does anybody know the formula for that? Nice and easy. So then we take our net operating profit after tax over total invested capital. I'll just go total capital. Don't judge my spelling up here. Will, stop. Are you recording? I love it. Capital. I'll get it eventually. Over total capital. So, for total capital, I'm gonna stop spelling capital. That's gonna. All right. So what I want is equity, which I can pull right off the balance sheet. Total shareholder equity minus my cash minus any non-operational investments. Most companies don't generally hold investment portfolios. Some might. Those that do, they're generally considered short-term equivalents to cash. So they're generally treasuries or really short-term corporate bonds, municipal bonds, and stuff like that. So this right here will give me net equity. What other source of capital am I missing? I can't just stop here. Who else has a claim to these assets? Debt holder. Total debt. a space here for a little bit more in our example, but this will give us total capital. Total capital. All right. So now I have NOPAT, I have total capital. That if I earn $20 and I have $100 invested, 20% return on invested capital. We'll go into how we think of return on invested capital a little bit later, but generally, rule of thumb, that needs to be higher than the cost of capital. That's how you drive true economic growth. If my required rate of return is 10% and I earn 10%, I didn't do anything. I didn't create any value for my shareholders. And we'll get into that when we think about growth valuations, because if that doesn't exist in the business model, future growth doesn't mean anything. Your valuation might still work if the assets are very undervalued or that company's very undervalued, but if there is no return on invested capital above the cost of capital, a growth valuation just does not make sense long-term at a company that's reasonably priced. So we have our total cost of we have our total capital, we have our return on invested capital. Now, we go through an example. Well, I guess first, if we're thinking of equity holders and debt holders, what should my required rate of return be? Does anybody know? What should I use?
WACC.
WACC, my weighted average cost of capital. I have to account for that because I have debt in there, which does have a lower required rate of return than equity. You could be aggressive and just keep that high, but companies with a lot of leverage are gonna look disproportionately better than others. So, any questions on any of this? I know I just wrote a bunch of stuff up there, so somebody asked.
For the total capital section, it's net equity minus total debt?
No, net equity
Plus total debt.
plus total debt. And we'll add another piece in here because why not make it a little bit more complicated for our example? All right. Any questions on net operating profit after tax? Nope. Any questions on total capital? No. So, other typical ratios people can use is return on assets, return on equity. The problem with return on equity is it doesn't quite include leverage, so that can look high for companies that operate with a large degree of leverage. Return on assets doesn't quite encompass cash, so if somebody holds a lot of cash, they'll have a lower return on assets even though it's not operational, so we like to kind of account for that to more normalize the playing field when we're looking at companies. It makes it easier to think of them on a relative basis. Using our weighted average cost of capital here. All right, so we're gonna walk through an example here, but we gotta add we're gonna add two pieces. So the example we're gonna go through today is Tractor Supply. They're a retailer. What we have to think about when we look at retail businesses is lease obligations. And recently, leases have had to be capitalized. What was it, 2018? Leases had to be capitalized and included on the balance sheet, just about somewhere in there, 2018, who cares?
Something like that, yeah.
Come on, Will, we gotta give them some actual knowledge here.
2018.
There you go.
Maybe.
2018. So the problem with that is lease capital, we like to think of it as an actual debt capital. Just because it's an off-balance sheet liability doesn't mean it's not real. Essentially, leases are used by retailers that don't either have the ability to bring that extra debt on the balance sheet to purchase those buildings or don't want to. So it can make their return on invested capital or return on equity look supercharged compared to other businesses. So what we like to do is capitalize those costs. So we just add that right under here. We'll add it in. Capitalized leases. And we can do this for any business. I mean, it doesn't have to just be retail. That's just the glaring example. Most businesses don't operate with a substantial amount of lease obligations, at least operating leases. So that we're gonna include that here. If we add that in for total capital, and we're gonna calculate it into our actual valuation, what I like to do is I'll just add my lease payments into my net operating profit. to include that when I'm considering the valuation, because I'll include leases into my enterprise value as well. But it adds like that, or it goes through the same process as adding back interest when we think about that. Because those are earnings that those lease, or that lease that has claims to. So we add that back in. Let's. How do you not get lost up here when you're like writing on the board? Keep forgetting where I wrote stuff. But then we'll go net income. Plus my lease cost. Plus after tax interest. And we're gonna add one more layer to this. So one thing to think of, especially when you're valuing growth companies or companies that have potential for growth, their CapEx, it's generally gonna be a little bit higher than their depreciation expense. If they're reinvesting into that business, they're reinvesting for growth. So what we wanna kind of peel out of there is if the business was kind of to stop today and just grow at a normalized rate, how do we kind of peel that back and give us a better understanding of what current earnings are? So we'll add our depreciation. This is a non-cash expense. And then subtract out an estimate of maintenance CapEx. So say a company could be spending $50 million a year on CapEx, but they're in growth mode. If they really wanted to just keep their business growing, just with the economy or just with the market and just going at its normal level today, say that was at 250 million, we want to try to understand that aspect. So when we value their true current earnings power, we add that back in instead of kind of penalizing them for investing into growth. So does that kind of make sense? I try to benchmark this. Either sometimes management is nice enough to add some color around what maintenance CapEx is inside of their financial disclosures, other times they're not, so you just gotta kind of understand and use your best judgment of what that number would be. And you can kind of benchmark it to revenue if you want, just so you can include it into valuations over time, but that will give us our net operating profit assumption. All right, any questions on that? I know we added in lease obligations, and maintenance CapEx. Any questions? Feel free to jump in.
For the lease cost, is that only capital leases or operating leases too?
Just capital leases
capital
for this
leases.
example. And the
Okay.
easiest way, this is just quick, back of the napkin math, lease cost. So what are we spending each year on our leases over the cap rate for that type of real estate? And that's easy enough. That'll give me my capitalized lease value. So the cap rate is easy enough to Google. You can look that up. What's the retail cap rate? Nowadays, I think it's around 6.15%. So take in our example, it's a little over 400 million divided by 6.15%. That'll come out to somewhere around like $6 billion of theoretical, how much it would cost me to buy all those buildings and just have them inside of my operating model. So, any questions on that? No? Good. All right, so we have total capital, we have no fan here. So I just pulled up a few examples for Tractor Supply here. So we have circled, so we have our depreciation. This is the income statement, so we have our depreciation at 342 million. We have our interest expense at 30 million. And we'll make sure we do that after taxes to give us the value of that tax shield. And then we have our net income at 1.8 million. Just keep everything. So right? I've included this on a different slide, but I'll show you lease costs are shown somewhere else in the financials, and then maintenance CapEx is estimated somewhere else, but I'll show that in another slide. Okay, now we're looking at the balance sheet. We have at the top, we have our cash, 202. They don't carry any substantial investments outside of cash and equivalents. Long-term debt, 1.164. Got my total shareholder equity, 42. Calculated out our net equity, and then operating leases are shown on the balance sheet, but they're kind of underestimated. It's more the net present value of the next roughly 10 years of lease costs, which kind of underestimates that liability in our opinion. So we do it our own way, which I'll show in the next slide. Here we go, we fill it in a little bit more. So the lease obligations, like I said, is our lease costs, which was about 400 million, divided by our estimated cap rate. That comes out to about 6.569. So we can see that equity's up there. And then our lease costs. Should we add that back in? Maintenance CapEx was estimated at about 2.25% of revenue. And actually in this year, they didn't invest too much into growth, so it didn't matter. Sorry, some of those numbers are a little different because I pulled these off a fact set and showed you the actual ones, so depending on them, they might be a little messed up. But no pat, 5.2 roughly. Invested capital is roughly 9.6 million. So if we do our return on invested capital, I'm probably like behind the screen right now. So, return on invested capital, we'll go 152 over 9.96. So anybody do that calculation quickly? We calculated something around 15%.
15.82.
All right. So that's our return on invested capital up here. All right. So we have no PAT. We have our growth. We have our return on invested capital. Growth is the same. Now we need our weighted, our required rate of return. So right there. All right. So typical weighted average cost of capital is my weight of equity times my required return on equity plus weight of debt times required return on debt times 1 minus the tax rate. So I gotta account for that tax benefit. I hope I wrote that right. Sometimes I gotta remind myself. There you go. So typical weighted average cost of capital. So when I look at my total capital number, and we're gonna add another wrinkle in here to just account for our lease liabilities. Generally, you can just count it as debt and carry it at the same cost. For this one, I actually carried it a little bit higher, so I just included it in there to kind of bring up my weighted average cost of capital. But my total capital is just over 9 billion. Just do the equity divided by that to get my weight. Same with debt, same with leases. So I just add this in over here. This is not a book definition, so I wouldn't use it anywhere. But this is how I did for this one. If you add, again, if you add the lease capital into debt and just use that same cost, or maybe just a little bit higher, to kind of account for the fact that debt would cost a company a little bit more if they were to say all of a sudden put $6.5 billion on their balance sheet. Their cost of debt is definitely going to go up a little bit as leverage does. So we do that up here. You can see your weights, tax rate, come out to a weighted average cost of capital of just under 6.5%. We talked about the cost of leases. We just use the cap rate. Cost of debt, I like to just, if the company has existing debt, I like to kind of match up the duration of my investment with the duration of the debt capital that I'm using or the cost of that. So I try to find about roughly 10 years. So I'll look at what they have a bond maturing in 2032 or 2030, somewhere in there. I'll kind of take that and then maybe even just round it up for conservative, just the sake of conservatism. But that's at about 5.5%, and then the cost of equity, I simply use the current rate of a 10-year treasury note and then an estimate of the equity risk premium. I cheat on that a little bit, and there's a good professor out of NYU, Aswaf Damodaran, that puts out the current equity risk premium, or the implied current equity risk premium of the market. So I kind of steal that. Another way to kind of think of it to make sure I'm coming out to a reasonable number for a cost of equity is I like to think of the cost of equity as an opportunity cost. Opportunity cost. So what that is if I'm an equity owner, where else could I put, or what's a reasonable expectation of return if I was to put my capital somewhere else? So that could, what do you think we'd use for that? What do you think we'd use as kind of our benchmark for an opportunity cost? The S&P 500. What if I just bought an index? Instead of buying this company, I put it in the S&P 500. What's a reasonable return? Does anybody know what kind of long-term return? Roughly 9. Yeah, it depends on when your time frame is. But roughly 9 to 10%. It's a little bit high. There's different periods where that's a little bit lower. But for this sake, I like to think of my range, what would be reasonable, somewhere in between 6 and 10%. 6 on the really low end if we're being conservative, 10 if we're being a little bit more aggressive. Depends on the business you're looking at. But as long as this cost of equity with the market inputs falls in a reasonable range, then I think it's pretty much okay. So you can use the CAPM model. I guess beta is a little bit of nonsense that we don't really. Why is everybody looking at her to the business? Who cares? Beta doesn't capture upside or downside volatility. So I don't care if I earn 100% on something, if it's a little bit volatile on the way up, who cares? I mean, that's why I think of it in this range. If I want to increase it, say I'm looking at a business that I don't have as much confidence in the business model, it's a little bit higher risk, then I'll just bump it to 10, bump it to 9.5. If I'm looking at Walmart or Costco or another really high quality kind of stalwart type company, I could drop it down to 6 if I want. I generally just keep it I'll keep it around that number. Maybe I'll take off the 25 basis points just to help out and go to 8, but I don't like to make it too conservative over time. So I'll generally leave that, then we get it to our weight. Does that kind of make sense? Kind of thinking in that range, using these inputs. I can send Will the website that I use to kind of get my equity risk premium from, if you guys were ever interested in that. But those are generally our inputs. We get to a weighted average cost of capital around 6.37. And this job is a lot of rounding and estimating. So what do you think I used? If I'm rounding or estimating, and just in the spirit of being conservative, I use 7. Is it up there? Yeah, my discount rate. So I use 7. So these are kind of our inputs. Apologies for not having it in the same format of the model, but essentially, million times 1 minus 2 over 7 minus 0.2. Generally, it'll get you right there. So what this valuation's telling me right now is, as you can see, there's actual downside. my implied value is lower than the actual enterprise value of the business. Since I included leases, I guess I didn't do my enterprise value yet. If we have to calculate enterprise value, do we have it up here? I feel like I wrote this.
You did have it.
Oh. I'll just do it one more time. So we have market cap, thanks for keeping me honest, Luke. Market cap plus total debt. What else did I include in this valuation that I need to include one more time?
Minus cash.
Well, minus cash. I want to include my leases. Leases. So I included it back in the valuation, so this is it, yeah. I want to include that back into my cash flow. Minus out cash. So that's quick back of the napkin way of getting to an enterprise value. So I included all those cash flows back into my estimate of net operating profit. So what this tells me right here, this doesn't automatically make it not a reasonable investment. It's just what's this implying? What do I need to make this attractive now? What do I need? Like, yeah, well, theoretically, I need growth. This is the current earnings power, our value, the value of current earnings. So what I need for this to now look attractive to us is, do we think future growth is reasonable in the business? And that's where we'll jump to next. Any questions on this model? No. Alright. Well, I'm really not loving the recording here. Anybody need any of this, or can I erase some of it? It's valuable. I was really hoping somebody'd say, no, I really wanted to write that down. Looks important. Alright. I hope he deletes that video. Quick, one thing I want to kind of harp on a little bit more is, if we are going to include growth or assume growth when valuing a company, we need return on invested capital to be above the cost of capital. It just doesn't make any sense in a valuation if it doesn't. So if I earn $1, you guys know the typical DCF setup. I have a return on invested capital of 20%, cost of 10. Okay, in year one, I make $1, or I have the $10, we'll use the same example, $10 of invested capital, I earn my 2, I gotta think how to set this up. Just think of when I discount stuff back, if I earn that extra whatever on capital, if I earned my 20% on my $1 this year, plus 9. Gonna slow down here. If I use 1 plus, now my required return over 1. Okay, for that $1 to actually be worth something that I reinvested back into business, I definitely came here and gave this presentation once. It did this example a little bit better. But if I add that in, so my 1.1 over 1.2, this is going to be greater than $1. So I actually had growth in the business. If I was to bump this up or drop my return a little bit lower, and I only earned, say, 5% over my 1.1, again, assuming the cost of capital at 10%, is this more or less than $1? It's less than $1. So this is where, if my required rate of return doesn't stay above the cost of capital, I'm actually destroying value for shareholders over time. So, there's that. So, one thing, and this is more conceptual than just writing stuff up on the board for equations, but If I think of a business that can generate returns on invested capital above the cost of capital, what exists in that business? A competitive advantage. You have to have an advantage over somebody else in the market to generate this excess return. Because if company X goes to market and they can generate 20% on invested capital in a product or a business model that has no advantage over anyone else, no reason why they should have that pricing power, it's eventually going to get competed away. Well, let's just talk through some examples of sources of competitive advantage. So you guys know Porter's 5 forces? Easy enough. Threats of new entrants, threats of incumbents in the market, threats of substitution, what's my customer's pricing power, what's my supplier's pricing power. That's good, but what are the sources of these kind of competitive forces? So some, if we call for price premiums, so companies that can charge more than others. Some examples: one, innovative products. So these are products that either are hard to replicate by other businesses, or you have some type of patent protection, which then you can charge premium prices to customers. So if I was just going to sell an Expo marker for 20% above market, every other Expo manufacturer is going to flood the market with products until market forces drives that back down to a reasonable return. Brand. Quality. What else we got? Or switching costs. Alright. So brand is just brand recognition. I want to buy that product for above market because I think it looks cool. Quality is there's actual quality from that actual product is higher quality than others, and then switching costs is pretty self-explanatory. Let's just go down and make this a little bit more interactive. Somebody give me an example of a business that can charge a premium price because it has an innovative product or potential patents. You can give me an actual company or just maybe an industry.
AbbVie.
AbbVie. There you go. AbbVie. So pharmaceuticals. Pharma is the big example for patents. Anything with just an innovative product. You can just say Apple.
Apple.
Phones were hard to, especially when the iPod came out. That's the same technology as all MP3 players. They just packaged it differently and created a more innovative product that was harder to displace by other competitors. What about brand name? There's a glaring example that if you read anything by Warren Buffett or basically anybody else in the industry, that what brand stands the test of time?
Coca-Cola.
Coca-Cola. There you go. What about quality? Brand and quality can be almost interchangeable. Sometimes brands are synonymous with quality, but the quality's not actually there. Or they did come to market originally with higher quality than others, but that quality was replicated, but that brand name had some staying power. What about quality?
John Deere.
John Deere, that might actually work. We'll go with Deere.
Cummins.
Cummins, there you go. What about BMW?
Yeah.
BMW in cars.
Apple again.
Apple, yeah, and that's another point is companies can have more than one of these forces that help them with their competitive advantage. Switching, what about a switching cost?
Any software company.
Apple is going to be another example here, but we can also get Microsoft. All of us know how to use Excel, all of us know how to use PowerPoint, all of us know how to use Word. If some other company comes out with, and I think there are other options, but something that's just slightly better, I'm not going to learn how to use it. I don't care. I can get what I want done with Word. I can get it done with Excel. If it just adds incremental benefit, I'm probably not going to move.
Keynote.
I don't even know what Keynote is.
PowerPoint is an example.
See, exactly. But all right. So we have our pricing powers. Then we have capital efficiency. I don't spell that wrong. Capital. I'm just gonna leave it there. All Alright, so some companies, they can't charge a higher price just based on their product, but they can operate in a more efficient manner than others. So some sources for that are economies of scale, and then scalable product. So economies of scale, they're especially prevalent in manufacturing companies. So you think, I'll use semiconductors for an example, either Taiwan Semi or Texas Instruments. They've spent decades building out a manufacturing footprint that allows them to produce their products at a more competitive price than others. It would take an exorbitant amount of capital to replicate that manufacturing base, so they have economies of scale versus other competitors, especially new entrants into the business. We'll put TSMC up here. Okay, scalable products. Somebody said software already. You're going to see that's a recurring theme. Scalable products is it takes minimal incremental capital, if not zero, to sell my next product to somebody else. So if you think, well, I guess Microsoft Office software doesn't cost Microsoft any more money to offer that tenant. They've already invested all that money to develop it. So if they sell it to me, they sell it to you, they sell it to the university, it doesn't matter. They don't have to add more capital to do that.
What about Adobe Reader?
Adobe Reader's another one. Scalable product. So you got Adobe, you got Microsoft. And then one last one that is arguably one of the most powerful forces for a competitive advantage is it increasing returns to scale. So it's a little bit different than economies of scale. Increasing returns to scale. So not only when I grow do I become more efficient, but I'm able to pass on more value to my customers. Anybody have an example of that?
3M?
I think I might argue that that's just economies of scale.
Okay.
What about Costco? What about Amazon? These are some glaring examples of why these companies have been able to grow so efficiently. Is as Costco grows, now they can exert more pressure onto their suppliers to then pass on savings to customers.
Could all be an example?
Aldi's probably an example too. So there you go. Walmart, but Costco, Amazon, kind of glaring examples. That's when economies of scale become a little bit more sticky, because I'm able to start passing on savings and make it even harder for another company to because I've compressed that margin now so much that it's going to take X amount of capital to compete against me, but then you're also going to be losing money for decades to catch up.
What about like Booking?
Booking.com. As they get bigger, they're able to put more listings on the platform. That's good. Yeah. All right. So these are kind of, once you have Porter's Five Forces is good for understanding an industry, but now when we're looking at individual businesses, what boxes are being checked? Why can they generate higher returns on capital and sustain that than other competitors in the business? So hopefully that's just good kind of a framework to think about a business over time. Here's your typical growth valuation. I know I talked a little too long. This is a 15-year DCF model, and one thing that you can view for growth models is it's easy to just extrapolate past performance forward. What's my earnings growth? What's my operating margin over time? You can use a single stage where it's just straight growth and then terminal value, or multi-stage. I suggest looking that up. I mean, an H model where you have a hyper growth period and then a kind of either a straight decline to market growth or kind of a linear decline to your terminal value, which we can talk about. But those are easy enough, but I would challenge you to maybe try to understand what's going to drive growth. Tractor Supply management actually has a clear roadmap for adding new stores over the next roughly 9 years. They're looking to hit about 2,700 stores inside of their footprint by adding about 90 stores annually, split between their main banner of Tractor Supply and then PetSense is another banner that they own. So how I did this model is I took historical growth rates, what's the number today for existing store growth or sales per store, new store sales per store, what are the historical growth rates, actually cut those in half to make my valuation a little bit more conservative, but then I modeled out what that growth is going to look like over time. So I added those 90 stores per year, calculated it, existing stores got the sales per store X, which is a little bit higher, new stores got their sales per store, took that, took my operating margin, that's how I kind of dropped it down to Notepad. Like I said, net operating profit, I did take taxes off, but for this screen, didn't have that in there. Took my taxes off and then I added back my lease payments and I just estimated that at about 3% of revenue over time. One thing that's difficult for valuations that you're looking into the future, one big assumption that you have to make is that your capital structure is staying the same. That's my weighted average cost of capital calculation, which you're going to use through the whole valuation. That assumes that your capital structure is staying the same. That assumes your costs are staying the same. It's kind of hard to model that changing. You can, but the more assumptions you make, the more opportunities you open up to be incorrect inside of your valuation. But that's why I kind of just kept my lease payments the same at about 3% of revenue. So jump over here, my key inputs, again, the 90 stores adding per year, that was about 9 years it took them to reach their management's target for their total store footprint. My starting values for existing store sales, new store sales, what that growth rate each year would be inside of both of those subsets of stores, what my operating margin is going to be, discount rate, again, perpetual growth at 2%. Nothing can grow faster than the actual economy over time, or else there'll be a halt to the economy. We're good. But then you got your estimated value, estimated present value. My margin of safety is a little bit higher here, so that's about 30%. All done. I know that was kind of a big brain dump of a bunch of stuff, and I appreciate you guys kind of bearing with me. I'm not as clean cut as old Will Morrison back there, but tried to get to it all.